blockchain is moving closer to mainstream finance. A new forecast from Standard Chartered suggests that tokenized assets could reach $4 trillion by 2028. This projection is not just about crypto. It's about how traditional financial assets are being reimagined on distributed ledgers. The report highlights two main categories driving this growth: stablecoins and tokenized real-world assets. Each is expected to represent roughly half of the $4 trillion market. This shift is not speculative. It's backed by institutions exploring blockchain as a modernized infrastructure for finance. Banks, investment firms, and corporations are experimenting with tokenizing bonds, stocks, commodities, and even money market funds. These assets can now be represented as digital tokens, traded not just during market hours but 24/7, and used as collateral, yield sources, or liquidity reserves. The appeal is clear: faster settlements, lower costs, and improved capital efficiency. Tokenization allows assets to be composited, meaning they can be combined and repurposed in ways traditional finance never could. This is why Wall Street is paying attention. The same tokenized position can generate interest, be transferred instantly, and be used in. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Multiple financial operations simultaneously. The report also suggests that DeFi protocols could become central to this new digital finance landscape. DeFi, or decentralized finance, is already a hub for automated financial services. If tokenized assets grow as predicted, DeFi platforms may become the backbone of this transformation. The report comes from Standard Chartered, a major global bank. On May 18, the bank released a projection that could mark a turning point for the crypto market. The forecast is not just about numbers. It signals a deeper transformation in how traditional finance operates. Financial institutions are no longer just observers. They are actively building blockchain-based systems to modernize infrastructure. Tokenization is not limited to crypto-native assets. It includes real-world assets like real estate, commodities, and corporate debt. These assets can now be represented on-chain, opening new doors for liquidity and access. The report also mentions that stablecoins will play a significant role in this growth. Stablecoins are digital tokens pegged to traditional currencies or assets. They provide a bridge between crypto and fiat, making them ideal for large-scale tokenization. The $4 trillion forecast includes both stablecoins and tokenized real-world assets. This dual growth path suggests a broader adoption of blockchain in financial systems. The implications are significant. If tokenized assets reach this scale, it could reshape how capital moves globally. Settlements that once took days could happen in seconds. Collateral can be used across multiple platforms simultaneously. Financial intermediaries may see their roles reduced as smart contracts automate transactions. The next signal to watch is how institutional adoption of tokenization accelerates. Will more banks and investment firms begin tokenizing traditional assets? Will DeFi protocols? Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Scale to handle this volume? The market is watching for signs of real-world asset tokenization moving beyond pilot programs. The report also raises questions about regulatory frameworks. As tokenized assets grow, governments and regulators will need to adapt. How will they classify these assets? What rules will govern their use? The answers to these questions will shape the next phase of blockchain adoption. The forecast from Standard Chartered is a strong indicator that blockchain is becoming more than a speculative asset class. It is evolving into a foundational layer for global finance.